All right, welcome into the Cow Guy Close. Thank you very much. I am Scott Shellady, otherwise known as the Cow Guy, and the final Fed meeting of the year is just getting underway, and we expect no rate changes. They'll probably remain unchanged. At least that's what the CME Fed Watch tool says. All right, moving right along, though, regardless of what they decide to do and what the eco data says, Americans, they're just not feeling good about this economy, period. Really. In the face of the average American's economic worries, the Fed looks to stand pat on these interest rates, right? They're going to invoke terms like the job is not done yet on inflation and the labor market is still tight. So how can things feel so fragile and difficult on one hand, and yet on the other hand, you can see the Fed take a hawkish, aggressive tact on rates? Now, banknote.com, they did a recent survey. And personally, I really wasn't surprised by the results. Now, 59% of adults surveyed said they feel as though the economy is already in a recession. So that looks like Recession Island is getting a little bit more crowded, doesn't it? Well, the survey also showed that 50% of respondents, they are financially worse off since the 2020 election. 66% of respondents say that current economic environment has negatively impacted their finances just this year. Now, rates have gone up quickly in the last 15 months in order to tame inflation. Now, if inflation is well and truly tamed, and I don't think it is yet, but let's just say they get there, shouldn't they just hold rates steady and only cut them if there are significant signs of weakness? Now, my next guest seems to have all the answers. Please welcome to the show, Craig Bolanos. He's the CEO of the Wealth Management Group in Chicago. Craig, thanks for being on. I don't know if you heard what that monologue had to say there, but it seems as though there might be a little bit of a disconnect between Main Street and Wall Street.
Scott, that was a great monologue. I felt like I was listening to Johnny Carson back from 1984 in the opening dialogue. I got to tell you, but it wasn't that funny. While Johnny was funny, you weren't, because if 59% of America already thinks we're in a recession, boy, I don't know. I got to look around because it doesn't feel like that where I live. Now, what am I thinking? Here's what I'm thinking. This idea that we're going to have 3 to 4 Fed rate cuts, it's absolutely insanity. It doesn't make any sense. There's so many reasons that the Fed should see this thing through. What do I think? I think at best, we're going to take the current federal funds rate, which is 5.25 to 5.5. We're going to see 2 rate cuts down to 4.75 to 5. I think that's a realistic projection, and that's enough to still grow equity prices into 2024.
Okay, I got to ask you the question. Now, I'll give you the 2 rate cuts as much as I don't think maybe. I mean, I think that the economy, like those numbers said from bankrate.com, that does tell us that the American consumer is hurting. But what the Fed's looking at yet, they're still thinking that things could get out of control if they see, the money supply grow or these rates come down. So here's my problem, right? We're supposed to take what the government says or the Fed says about getting interest rates to a level where they've tamed inflation. Now, if they get there and they can hold inflation steady, wouldn't you think that they would hold the rate steady? Why, just because inflation is now steady, should we cut them and maybe have inflation reignite? What do you think?
Well, Treasury Secretary Yellen was talking about that with, I do think that the real interest rates, I'm all excited to see what he's going to go ahead and say, which is going to be a nothing burger. But let me just come back and say this to your question. I think at the end of the day, the Fed is going to not want to completely disappoint markets. I said that, yes, they're not going to want to completely disappoint markets. They're going to have to give us 1 to 2 cuts. There's no cuts happening in March. I don't think a cut even happens in May. It's going to be in the second half of the year. But I come back to this statement again. The market is broadening here. Look at the equal weight versus the cap-weighted S&P. Look at all these components. I don't think people need to be running for the hills, and I don't think people need to lock up into long duration just yet. Treasury prices will stay high with all the geopolitical uncertainty, but everyone's got to start positioning for what is going to be a different second half 2024.
Okay, so you say that they don't want to disappoint the markets. I mean, what's the S&P 500 up year to date? I mean, I know the Dow's up just over 10% year to date, and the S&P's got to be doing better than that. That doesn't sound like they're disappointing anything.
No, there's not, but you have to understand, too. I mean, all the people who are, listen, small caps are up 5, mid caps are up 8, large caps as measured by the S&P 500 up literally 20%. Those are fantastic numbers. But I do think there's this big expectation. And what the Fed does not want is, I believe, they're not supposed to be doing this. I don't think the Fed wants to see some retracement. I don't think the Fed wants to see some bear market come in, because the wealth effect matters. The better people's 401k performs, the more likely the consumer is going to feel good about continuing to spend, even though it's going to be on the Capital One credit card.
You're right, and it's this 15-year gap that we have in our history now that everybody's going to look back and say, boy, didn't the Fed really distort all asset prices by artificially keeping interest rates low? And then all money managers that were 36 years old in 2023 after they graduated in 2008 at the age of 21 thought that everything was always supposed to be at 0% interest. I mean, that's kind of a dangerous equation, if you ask me.
But that could be a dangerous elixir. I mean, this experiment that you and I talked about last Friday on your radio show, I think maybe even on this TV program as well,
yep.
ZREP, zero rate interest policy, that was the last stand. I mean, it was over. We were economically going down the toilet. And I actually give credit to those who came up with the idea of literally lowering the cost to borrow at zero and hope Americans would do what we do well, which is spend money. But we exited this policy way too late. Everybody knows that. The historians are going to be accurate. And I just think people right now, from an investment standpoint, again, should be focused on what's in front of them. Stay in the front side of the Treasury curve. Make sure you start lengthening maturities, though, once we get to the second half of next year. Don't bet your retirement on the Magnificent Seven, and that's what you're doing if you're an S&P 500 only investor right now. I think people should be equal weighting. There's no doubt about that, but the world is not over. People don't need to be on Recession Island. I do think the consumer, though, which is softening, the consumer which is choosy, in the second half of next year, I think the consumer will buckle just a bit under the pressure of higher rates and student loan repayments.
Thanks for coming on. Great content as usual. We'll take that to heart, by the way. Thank you very much. Craig Bolanos, CEO of Wealth Management Group. All right, let's take a look at those equities that Craig was talking about. What's the Dow doing? Well, look at this. After that announcement, 189. He must have said something, because we're 183 points higher. We were really basically doing nothing, or say 200 points higher. So it'll be interesting to see what the rhetoric was there. But the market loves whatever he had to say. Let's take a look at the S&P 500. That one's going to be up too then, I guess. Yep, 27, 8 points. There you go. 28 points higher. That's the S&P 500 stocks. So he's not disappointing the markets, as we just talked about with Craig. How about the Tech 100, the NASDAQ? They love it too. That's up over 100. And then finally we'll go to the mom and pop stocks, the small to mid caps. We just talked about that. We're up between, say, 17 and 18 points as well there. So he isn't disappointing anybody when it comes to your 401k. All right, every time we do a segment on the war on beef, the cow phone lights up. So we're going to give it another go. We're going to go back to that well. We've told you how global leaders are now calling for you to greatly reduce your beef intake. They'd rather you eat bugs. Now, my next guest has what you call a you first strategy. That's Bob Iacchino. He's going to be up next when the Cow Got Closed returns after this.
The Farmall has been an iconic partner on the farm for generations. Come